Welcome to What School Should Have Taught You, a podcast where I share with you all the lessons you need to know about wealth creation and answering your questions along the way as well. Click the link below to send in your questions and you could be chatting with me here on the show. I'm going to share with you a really good question that's coming up from a young man named Andre. $70,000 worth of savings between him and his cousin, and they're really wanting to know where they can get started or how to get started and the right people around them to give them the assistance that they need to make the right decisions moving forward. Let's jump straight into the episode and chat with Andre right now.
Everything school should have taught you in one place. With a property portfolio of over 17 million and an accountancy firm of over 16,000 clients, as well as being an accountant to some of the wealthiest people in Australia, Jeremy Iannuzzelli will be sharing his lessons on everything school should have taught you so you can build the life you want.
G'day, Andre, mate. Thank you very much for calling in. How are you today?
Yeah, good. How are you? Thanks for having me.
Mate, thank you very much. Now, I hear you've got a fantastic question to ask us, and I think what we are going to hear from you is something that's very commonly asked, and at the same time, there's a lot of other people in your certain scenario. So, mate, I'm looking forward to your question, mate, so I'm going to let you shoot away.
Oh, thank you. So I was just curious about if it's possible to get an approval for a loan as a 19-year-old without a full-time job. So me and my cousin have a bit over 70K in savings together, and we wanted to do a joint venture. Sometimes when we speak to a mortgage broker, they say we need a full-time job. Is there ways around this so we can get our foot in the door? Is it better to wait a few more years until we have finished uni and have full-time jobs? I like the idea of getting our foot in the door now so we get growth and rental income so we can prepare for a second property in the future.
Beautiful. All right. So it's a very common question I get asked all the time. I want to invest with my friend. I want to invest with my brother, my sister, my parents.
Yeah.
When to go into the property market, when not to go into the property market. Should we wait? Should we save up more money? Number one, Andre, well done. You're at uni, 19 years of age. You've got some money being saved up with your cousin and you're making your first leap, even asking this question and probably researching property. So number one, well done.
Thank you.
Well done.
Thank you.
Don't stop the hustle. 19, you've still got plenty more years ahead of you. But let's start with the first answer to your question. And we're talking about the loan itself. Now, banks, there's probably about 50, 60 different lenders on the panel of many different mortgage brokers. Banks traditionally were where we went to get the loans, and now mortgage brokers are the ones that we generally speak to, and they make up a large portion of all the loans that get written in the country. Now, I have met, Andre, so many different mortgage brokers. I've met some really great ones who understand how to read a P&L on a balance sheet, are problem solvers, they work through it. They'll also give you scenarios that you can improve to put yourself in a better position for more borrowing in the future. And then I've met mortgage brokers who are transactional in basis. Now, we've also got to remember how they get paid. They get paid on the basis of writing you a loan. The bigger the loan, more they get paid. The quicker the loan, the quicker they can write that loan, the quicker the money comes to them. So at the moment, when they're looking at you, I think they're looking at a transaction as opposed to a journey that you and your cousin want to go on. They look at your incomes, they probably look at your savings, and they say, hey, the amount of effort we need to put in with, Andre and your cousin to get you a property, we're not really going to get paid for this, or not a huge amount anyways. So the first start of your journey is you need to find that professional who's willing to go with you on your journey. That professional should be asking you questions. Andre and your cousin, what do you want? What are your goals? What are your objectives? These are the things that you guys can do to improve your situation. These are the things that you need to hit off, action point 1, 2, 3, to get where you want to be. Now, to put the answer short, yes, you and your cousin should be able to borrow. Yes, there's many people who are on casual employments. There are some banks that like to deal with casuals and they'll annualize your income based upon your year-to-date pay slips. So for instance, if you're only working,
banks those are?
I'll probably suggest the majors are the main ones. I know ANZ and CBA, they'll generally annualize your pay slips, but they'll want to see very strong year-to-date figures. Better to chat with a good journeyman mortgage broker on that one, because and when I say journeyman mortgage broker, a person who's going to be with you along the whole transaction and the whole journey with you and your cousin. You've got to find that person willing to put in the effort. Now, as I said, the answer is yes, you will be able to borrow. How much you can borrow really depends on your level of year-to-date income between you and your cousin. So that's the first thing that we want to do. We need to create the picture. for you and your cousin to make a decision whether you want to move forward with being able to buy a property, whether you do it on your own or you do it together, you need to get a little bit of the rules of the game. You need to get the picture in place. How much can you borrow? What things do you need to be doing that? What level of deposits that required? What's our commitment in terms of capital that's required to do it? And then there's obviously a couple other parameters in place. Now, the second answer to your question is a big one. You guys have got $70,000 that you've saved up between you. You're 19 years old. You're currently at university, and you're looking to do a JV together. So a couple of things need to be really looked at when you're considering going into a JV. Number one, are you and your cousin on the same trajectory?
Yeah.
Beautiful.
So.
Because what I tend to see in my experience when many people are doing this under the JV agreements is it all starts off as peaches and cream. Your cousin and you've got the same path moving forward. But the challenge is that later on in life, you want to go down your own path of investment and your cousin wants to go down his path of investment, or you might want to go into separate businesses, you get married, you get engaged. And what happens is, and these are the things that, people don't tend to tell you, is that there are asset protection issues. So when you guys do own a property, say 50-50, there are things that come into play. Something goes wrong with the property, whether it's divorce or someone gets sued. Lending is probably one of the biggest issues, Andre. And why I say that is that most banks, and we'll come to what a common debt reducing facility is, but most banks, what they'll do is they'll look at only half of the income that you're earning, because Andre, you own 50% and your cousin owns 50%. So when you go to get your next loan, they'll say, Andre, your $20,000 rental income, we're only going to show $10,000 as applicable to you. You guys have borrowed, sorry, mate, my apologies. You guys have borrowed $350,000. Now, the way that the banks look at it is they say, Andre, what happens if your cousin runs away to Bolivia and never comes back? Who's going to
owe all of it?
That's it. Who's going to pay the loan? Where are we going to get our interest payments from? So, Andre, when the bank looks at your assessment moving forward for your next couple of properties, they're going to take that full $350,000 debt in your own name.
Yeah.
And that becomes a challenge because you only get to show half of the income, which they do shade for expenses. And shading means that they won't take the full, $200 a week, which is 50% of the $400. They might only take $160 a week because there's council rates, water rates, and other things. So they'll shade that income, of which 50% of it's yours. And then they'll take the whole debt, that whole $350,000 in this example being applicable to you. So the challenge is that it may become a little bit of a hurdle or a roadblock for when you're looking to buy in the future. Now, there are banks with what they call a common debt reducing instrument. And this common debt reducer means that, hey, yes, Andre, we're only going to take half the income, but because we're confident that your cousin can handle and settle his half of the debt, we're only going to take your half of the debt as part of the interest calculation. But from experience, I've been in and used the common debt instrument myself with a close friend of mine who we built together. You had to get statutory declarations. You had to both hand in your financials at the same time. And I was lucky enough to be the accountant of my friend at that stage, so I was able to do things in a timely manner. But if your cousin's very sloppy with his bookkeeping or his tax work or his returns, then it does become a little bit of an issue for you. And that's where I tend to see, Andre, a lot of family friends become enemies over time.
Yeah.
So that's also something that you need to consider as well. It's some of the cons that are involved with investing together. But if you make a decision that, you know what, we're very close, we want to go down this path together throughout the rest of our lives, and we're very confident that we can do so, then that's an opportunity for you as well. A couple other...
So we were... sorry.
No, you're right, mate. You go.
So we were thinking of, we just wanted to use this property as like a stepping stone to help us get a separate property, whether that's like separately if we go our own ways. So we were thinking this of more like a short-term goal where we can say, let's say we hold it for like 8 to 12 months and added value to it, and eventually selling it off for profit. It would give us a better position so we could both go our separate ways and be a better position for our second property.
Now, that I don't mind. That is not a bad scenario at all, because that is a way that you guys are joining your forces, joining your capital to do something, putting in the time together, I'm assuming, to give it a coat of paint or do something that you need to improve the value, and then making a bit of money, which is going to bolster your individual capital, individual reserves, your individual savings to then do your own thing. Now, I don't mind that. I think what you also need to consider for yourself and your cousin, depending if your cousin's bought a property in the past or not or before, is that you need to take into account the potential first home buyer grants as well.
Yeah.
That's very important. Sometimes I do see people, they will forego the first home buyer grant because they've done the equations and they've said, Jeremy, we believe that we can make extra money or more money equivalent to what the first home buyer consideration or first home buyer grants are providing us. So as long as you guys are comfortable that, you've done your numbers, you've looked at the property, you're buying it, say, below market value or at market value with a greater opportunity to make a higher level of return, far more than what the first home buyer's grant would provide you, then I don't see it as a bad idea as long as your numbers are solid. What you guys need to do is you need to definitely put together a bit of a business plan. And that business plan will include your entry strategy as well as your exit strategy and what things that you will do if it doesn't all go to plan. If we don't hit this particular price, are we prepared to hold for 12 more months, 18 more months? Or is it simply going to be a decision that we sell? And if we lose a bit of money, so be it, we've learned some lessons, or we may break even. I think having some mitigating alternatives to mitigate any of the future risks important. If you guys are going to go down that path. But, Andre, on your question, I think two things. Number one, that broker is going to give you and your cousin the opportunity to create that business plan and set the rules of the game. So that's number one. Getting the rules of the game is important, so you know exactly the type of property that you can buy, how much you're borrowing, and how much capital is required for you to be left over to fulfill your renovation or small cosmetic requirements for the property. So that's number one. Yeah. Number two, I think that, the plan that you guys have come up with, which is an opportunity of going together, spending a bit of time together, many hands make light work in this particular situation, and then ultimately, hopefully sharing in the level of profits to boost up your savings. I love it. Absolutely love it. And I think as long as you guys take into consideration the lending, the issues that are around lending, especially long-term in the future, if you decide to keep it together. And secondly, the first home buyer grants and the concessions and considerations around that, as long as you guys are comfortable with understanding what those losses might look like in terms of the benefits you're not getting, I think it's a great opportunity for you and your cousin to go ahead and do this together and get your foot onto the property ladder.
Yeah, that's something that we wanted to do. Yeah.
Now, the one thing I will suggest, this is probably my parting comment. You mentioned at the start, is it too early? Should I potentially wait a little bit longer? Now, I've always been of the my experience always says that when you're hot, you get into it. Don't wait for things to cool, because generally it doesn't cool. And if it does cool, it cools too much and you're stuck in the freezer. So I think the opportunity for you and your cousin to take advantage of the market now, again, a little bit of higher interest rates at the moment. So the buyer pool has dropped considerably compared to the peak that we had in late 2021 and early 2022. But once you do get a bit of the game plan and your business plan together from the broker and you and your cousin, you need to then start to compare apples with apples. And that is if the game plan is we buy a $350,000 property because that's the absolute maximum that we can afford, then just stretch that slightly. Stretch that to $400,000 and have a look at the quality difference between a $350,000 property and a $400,000 property. Because sometimes it might mean that you and your cousin only need to wait an extra 2 or 3 months to potentially save that capital. And that's going to give you a greater opportunity to make a greater level of return. Because in most cases, when we're talking about percentage level of returns, the higher the denominator, which means the higher the purchase price. If we're making a 10% return on a $400,000 property, it's much more than 11% return on a $300,000 property in terms of gross value.
Yeah, okay.
So, I think from you and your cousin's point of view, just really do that little bit of comparison to see that, hey, is it worthwhile that we potentially look at a $400,000 property and wait the extra couple of months? Now, the argument can be said, Andre, that, what happens if we buy $500,000 or $600,000 property? Is it going to be far substantially better? The answer is potentially yes. But are you prepared to wait 1 or 1.5 years to save up for that additional purchase of the property? By that time, it might be a 1 foot forward, but the property's gone 3 feet ahead of you. Yeah. So we do need to take that into consideration and make sure that we're looking at the opportunity cost of waiting. But that's the leaving comments that I would part with you today is, A, have a look at, say, potentially, depending what the value is. As I mentioned, the broker might say that maximum purchase price might be 350. Just stretch that to 400,000 and see the quality difference. And if there is a substantial difference in quality and it's only going to take you and your cousin a couple of months, I would 100% buckle down and save that bit of extra coin, because sometimes you might find that the level of returns would be far greater.
Yeah, it's perfect.
Beautiful. So, mate, in summary, I just want to go through a little bit of a summary for you because I like to leave people with a bit of a 3-point action plan. Action point number 1, you need to find that professional, that mortgage broker who's willing to take a journey with you. All right. Even though they all work with inside the same parameters, they have got different attitudes and attributes. You need to find the person who's going to work with you, give you opportunity, and give you different scenarios that you can improve your situation. And you got to really share with them your goals and objectives. You want that person to believe in what you're aiming to achieve so they can help you get there in the long term. So that's number 1. Focus on a journey broker as opposed to a transaction broker. Action point number 2 is you and your cousin, you really need to sit down to do your business plan where you're working at your entry and exit strategies. And I also want you to look at alternatives so you can mitigate your risk the whole way throughout the process and obviously post the process when you sell as well. I wouldn't worry too much about any structures or anything like that. Your first bet is just to get the property between you and your cousin 50-50, nice and simple, make it happen and progress along your journey. And the third action point would be, just for summary purposes, have a look at a slightly more expensive property when you do get a bit of the fundamentals of what you're aiming to achieve. And I want you just to compare apples with apples. Is a $400,000 property from a quality perspective far greater than a $350,000 property? Because if someone told me, Jeremy, I'll give you 30 minutes of my time for $40 or 1 hour of my time for $45, even though $45 is a lot more than $40, I'm still going to take up the $45 for 1 hour because for that extra $5, I'm getting 30 minutes of more value. So I want you and your cousin to look at the extra value that you can cram into that purchase price by slightly going a little bit above what the top price that brokers provided you. And that's going to put you and your cousin on the right path.
Yeah. Thank you. That's given us a lot to look into.
Beautiful. Now, Andre, have I answered your questions today?
Yes, I believe,
Is there anything else that you would like to know, or is there any more clarification that I can provide you on anything we've discussed?
Maybe just a bit about how would I go about trying to find these different brokers and trying to find one that goes along with my goals.
Beautiful. And look, I think that's actually a very common thing that gets asked. The best way that I found the right professionals that I work with today is that I was reviewing lots of, obviously, podcasts. I was on lots of different property forums, and I was looking for the brokers that had built big portfolios themselves. So that had quite a number of properties in their portfolio. And I was looking for the brokers that worked very closely with a number of property professionals, because property professionals can't be successful without a great broker on the other side, giving the clients an opportunity to continue their growth in the future. So I would reach out to some really well-renowned property professionals in the industry, and there's many in there. Google's a great starting point. There's some really great podcasts in there as well that you can use. And by reaching out to them, asking them, who would be 1 or 2 or even 3 significantly fantastic professionals who are going to help me with my journey from a mortgage broking perspective. And I can almost guarantee you that you'd probably hear a common thread between many property professionals of who the best 3 are. And they're the people that you want to be working with long term. So that was where I would get you started, mate, from trying to find the right mortgage broker.
Thank you so much.
Andre, it's been a pleasure. I'm very thankful of you calling in and asking this brilliant question. I think it's a question that I receive all the time. And thank you for your time. Enjoy.
Thank you. Cheers.
I was really excited to chat with Andre, and I believe he's got a really bright future ahead of him. Him and his cousin have done so well to put themselves in a position which I believe is quite strong for a young 19-year-old, and he's going through the right questions to get his journey on the right track. And that's the exciting thing about chatting with some really young guys, really, really energized guys in the industry. But just for most things that happen, and for anyone that's listening, I think it's important to really understand that JVs are very tough. And Most do end, unfortunately, not in a good way, and it's not because of any infighting or it's not because of any issues of the particular joint venture itself, but it's more so to do with, we all take our own paths as individuals, and I believe that when you are in a joint venture or a business partnership, you really need to be going down the same path together for a very long time. A lot of the challenges you will face will be around financing in the future, could be around marriages, business planning. There's many different things, many different hurdles that you start to face when you bring two very different individuals together and you try to keep them along the straight and narrow for a very long time. I do wish Andre all the best. I think he's got a great opportunity, but those are the things that I really want Andre to think about, and anyone else that's listening to really understand that JVs, it does give you the opportunity of really amplifying things a lot quicker, but as we all know, what goes up very quick sometimes can come down. So it's one of those things that you need to have a think about. You've got to get your heads of agreements all in place to ensure that things are safe and sound now and well into the future. Now, if you've liked what you've heard, feel free to send in a question to the show. Click the link below, send in your question, and we could be chatting here on this show, and I could be answering your questions and hoping to give you a lot of clarity moving forward so you can start to make the right decisions for your personal wealth creation journey. This is what school should have taught you, and I'm Jeremy Iannuzzelli.